Hello guys and welcome back to this video. Today is a very exciting video because I'm going to be talking to you about how I have made money on Palantir despite the stock price being down and how you can too. So who is this video for? So this video is for you if you have been a long time Palantir shareholder and you are down on your stock price, or if you are new and thinking about investing into Palantir. I want to give you a perspective. I want to tell you where the company is going. And of course, as always, this is all just my opinion. This is not investment advice. Hopefully this is entertaining and educational. And you would honor me if you would subscribe to the channel to make sure that you don't miss any of the new videos. So let's go over to Palantir. Basically, this is the stock price of Palantir, and as we know, they didn't IPO, they DPO'd in September 2020. Then their stock price shot up to $40, and then pretty much where the stock market started hating the tech companies, it lost 50% of its value, and then when the stock market crash came, then it lost a further 50% of its value. Then we had a small rebound, and I actually bought here and here where you can see the arrows, and my cost basis on the stock is $11.75. And the price is slightly above that now. But why did I still say that I made money on it? It's because I think that this is going to be a $200 stock, and this is, or maybe $100 stock. But my point is that this is what's so nice about being a long-term investor and having the right mentality and being able to do your own evaluation and, understanding the company, is that you buy a stock, and then if the stock price goes down, you're happy because you get to buy cheaper. And if the stock price goes up, you're happy because you were right. So basically, you don't really have a way to lose unless you are so far off in your valuation. And in that case, the next company, you see what you did wrong and you learn, and then you will do better on the next company. But it's amazing to be a long-term shareholder and having this view. And honestly, I have some money coming in, and I am really hoping that the price is going to go to 10 or maybe possibly below 10 because of the market turmoil that is happening. But even if you don't like Netflix, I believe currently, if you know how to do valuations, there is insane how much deals there are on the market. I mean, even Netflix, I did a video about this. If you actually do the valuation like I do it, it's actually a deal. And I would highly advise you to look at it because it's one of those investments that you can just buy and hold it for the next 10 years. And you don't have to think about it. You just know it's going to be a very good company. But I digress. This video is about Palantir. So let's look into the valuation. So I made a very nice and fancy table that disappeared. So here we go, guys. So this is the valuation that you see, and this is not a DCF because one, I've done courses on DCF and I feel that they're so complicated that an average person can't do it. I mean, I probably could do it, but I really don't trust the numbers that I get out of it. So what I do is I model the revenue and the profit of a company. So basically, we know how much money Palantir made in 2021. And then we know that management is projecting a multi-year 30% growth for the company. And for example, in 2021, they grew 40%. And many people think that they're sandbagging this. So I just count with the 30%. But I will show you later because you can even play with these numbers. So I will show you later that it very much swings the valuation depending on how much they grow. And then I go to 2025 because I'm very interested in what is the stock price going to be in 2025 or in 2030. And I'm actually more interested in 2030 because I really like this investing. You just buy something, don't care about it for the next 8 years, and just check on the quarterly reports if they're still following this table, and as long as they're following, you're good to go. So then we know their operating margin, and this is also from their investor letter. And then I can model like what is their operating income. So here is where you can give me a lot of hate, is that they're not a profitable company because they are doing a lot of stock-based compensation. And this stock-based compensation is actually not a financial item. It's actually an accounting item, meaning that to retain the employees, they are issuing shares of the company and they pay some taxes on it. That's the only financial item. But this has nothing to do with their operations. So this is also a big part of my thesis on Palantir, that I do believe that they're a very misunderstood stock. I might be wrong on this, and that would make the whole valuation wrong, But if you believe that Palantir is going to 10x or 20x now, this is one thing that you have to believe in. is that the stock-based compensation is going to normalize, and they're going to be a normal company like Apple and Microsoft and maybe do 2-3% a year. I actually counted with 3% in my table, because otherwise they just mess up your valuation. So then, based on this thesis that, okay, I take away, I don't think with the stock-based compensation again, because it's only an accounting item, and I just want to show you where I get this from. This is their investor letter for Q4, and you can see here adjusted operating income, and you know, they have this little star here, and then they reconcile it in the bottom, and then they explain that they, you know, they take how much money they lost according to the bookkeeping, and then they add back in the stock-based compensation, and this is how you get this number, right? So going back to the table, so with this we get that probably in 2025, if everything is true what I'm saying, then they will have 1.3 billion profit, right? So now this is what's nice with this table, is that then we can make our own assumptions of, okay, how much should their PE be? Should their PE be 10 in 2025? That would put their market cap of 13 billion. That would suck. Okay, but okay, realistically, if they're growing 30%, then I believe that they are okay to have a 60p, and that would put their market cap of 89 billion. And what is their market cap today? It's 25 billion. And I even calculated back here, I divide the market cap by the number of shares that they have. So that would in 2025 give us a share price of $37, right? And then the last thing that I do in this table that I think is freaking cool is that I count this back. If we say that, okay, the stock is going to be $37 in 2025, how much should it be worth today if you want to earn 30% per year, right? 30% per year on an investment is quite high, right? Like many people are happy with even 20%. So if you are happy with 20%, then today the stock price should be $18. And then you look at where the stock price is, and then you will see that it's at $12 around, and then you can make your own judgment if you think it's a buy or not. Personally, I'm shooting for a 30% compounded return per year, and then as long as the stock price is $13 or below, it's a good buy for me, right? And this is, if you look at the table, even true up to 2030, where I project that the share price is going to be 137. And then if you want an annual 30% return, then the stock price should be $13 today. So now, like, this is why it's so important that you also know how to do this. And by the way, I'm going to make a Patreon page where this will be available, and the link will be probably in the video. So, because if you just look, if you don't know the company and then you just look at the basic data, it can seem like the company is crazy overvalued. I wouldn't blame you for thinking it, because, for example, their current market cap is trading on 52 times their free cash flow. They don't have any profit according to the bookkeeping. We all know what is with that. So even to get this number, it's a bit of a stretch, because I'm basically pretending that they have earnings, which they do. I mean, I really believe that they do. Their price to sales is 16, which is also quite high. But nobody is buying a company for how they are today, right? You're trying to buy the future. And currently the market is in a state that it's giving us a lot of discounts, because we are going into a bear market, and if the Fed raises 50 basis points in the next meeting, I believe there will be bloodbath in the market, and it's just going to be an amazing opportunity for new people to Palantir to buy in at amazing prices, or for people who have been investing in Palantir to lower their cost basis. So again, it can look really expensive, but another thing is that what do you compare Palantir to? Because, for example, a lot of people compare Palantir to Snowflake. And if you look at Snowflake, for example, as a competitive company, they have a price to sales ratio of 48. So meaning that if they had 1 billion in sales last year, then their market cap is 48 billion. So if you look at Palantir, their price to sales is 16. It's 1/3 of Snowflake. As you can see, this is taking into account that, I mean, they are like 50% off from the, no, more than, like probably 60% off the high. So that's how crazy overvalued they were. Again, I just want to show you, if you believe in this calculation that I did here, then I want to show you the things that have to be true. Otherwise, this doesn't hold any weight. So you have to believe that they are a secretly profitable company. And again, this is one of the reasons I talked about it a lot in my other videos, why Palantir is such a good investment, because, you know, you get a huge discount because people don't understand this company. And once it comes to light how good of a company they are, and really the stock-based compensation is not really a cost, which we all know because you and me are smart, but the people outside don't know, then probably they will get a valuation like Tesla, and then you will have missed out on all the upside, right? This is why we are getting such a discount currently. Then the second thing is that they will have to normalize the stock-based compensation, because it's a bit of a crazy amount that they're doing currently, and they promised in the last Q4 earnings report that they are going to normalize it, and I'm also counting with 3%. And I will show you that if you count with, let's say, 10% a year stock-based compensation, then it will radically decrease the price of the share. Then the next thing is you have to like and subscribe. All right, so then very, very big thing is that you have to believe that they are going to grow 30% per year for many, many years out. Obviously, this is something that, you can invest now, but you would want to check, like every quarterly report, like, okay, is the management still projecting 30%? Is it going higher? Is it going lower? And you also have to believe that they will be valued as a software company. On the valuation, I did a lot of Googling on, what could be a good P and what is a normal P. And I found NYU, where they collected together like the P ratios in the US economy by sectors. And here basically, I believe Palantir is in this category, software and system application, where, the average P currently is 107, as opposed to Palantir 50 something, again, based on their free cash flow. And the average growth is 22%, and the average PEG rating is 1.93. So as long as they continue to be valued, as you can see, I counted with that they will get a 2 PEG ratio. I mean, if I decrease the P to 1.9, now I'm below. Now this is a pessimistic calculation. You see this results in $35 in 2025 and $130 in 2030. And if you want, again, 30% return per year, then it's a $12 price target today. And that's the stock, I believe, is like $12.10 or something. So I just want to show you what happens if you change the growth of the company. Let's say they slow down and they get 20%. So 20%. So as you can see, just this change, that we change their growth to 20% per year, it makes their market cap, I don't remember exactly. Yeah, it was $37. Then the stock price becomes $25. And basically, if you want a 30% return per year, you would have to buy the stock at $9. But what if you're okay, like many investors are okay with 20% return a year? It's still a freaking good buy. And what if their growth slows down to 10%? I mean, then it's no longer a growth company. The stock then would still go to $18. And if you would want $30, you would have to buy it at $6. 30%, you would have to buy it at $6. But if you're happy with 10% a year, it's still a good buy at $12. So the reason why I like this table so much is, every investor is different, and you can play with different scenarios of like, what is the percentage that you're happy with? What changes can happen? And, we can put this back to 30, and we can say that they are going to dilute the stock. You see, so the price went back up to 35, and then we changed this that they're going to dilute the stock 10% a year. And as you see, it's still not that bad. Then we went from $35 to $33. If you want a 30% return per year, you're still good with buying the stock at $11. So again, this is not investment advice. I'm so happy you watched the video until now. I strongly encourage you to either visit Patreon, download this, and, run your own simulations. It's really important that you know how to do this evaluation. And I hope you come to the same conclusion that I have come to. And see you in my next video. Bye-bye.